Today, we will talk about cash and cash equivalents, the most liquid current assets on a company's balance sheet, which include bank accounts and marketable securities. Cash and cash equivalents refers to the line item on the balance sheet that reports the value of a company's assets that are cash or can be converted into cash immediately. Cash equivalents include bank accounts and marketable securities, which are debt securities with maturities of less than 90 days. However, oftentimes cash equivalents do not include equity or stock holdings because they can fluctuate in value. Cash and cash equivalents are a group of assets owned by a company. For simplicity, the total value of cash on hand includes items with a similar nature to cash. If a company has cash or cash equivalents, the aggregate of these assets is always shown on the top line of the balance sheet. This is because cash and cash equivalents are current assets, meaning they're the most liquid of short-term assets. Cash and cash equivalents help companies with their working capital needs since these liquid assets are used to pay off current liabilities, which are short-term debts and bills. There are some exceptions to short-term assets and current assets being classified as cash and cash equivalents. Although the balance sheet account groups cash and cash equivalents together, there are a few notable differences between the two types of accounts. Companies carry cash and cash equivalents for a variety of business reasons. A company may want to have cash and cash equivalents on hand too. In its third quarter 2022 condensed consolidated balance sheet, Apple Incorporated reported $27.502 billion of cash and cash equivalents. On September 25, 2021, Apple Incorporated had reported $34.94 billion of cash and cash equivalents. In Note 3 to its financial statements, Apple provides a substantial amount of information regarding what comprises this cash and cash equivalent balance. Apple classifies its broad assortment of financial instruments as cash, Level 1 instruments, or Level 2 instruments. Cash is the direct ownership of a government-issued currency. This may take the form of physical cash or digital cash, i.e. bank account balances. Cash equivalents have certain benefits over cash that make them better for some investors. However, both types of financial instruments are very similar and yield similarly low yields. The difference between cash and cash equivalents is minimal. Cash equivalents often have slightly greater yields than cash. Even buying one-month treasury bills may yield higher rates than what a company may get on their savings account. Cash yields also allows a company to strategically hold low-risk investments for future use while still attempting to preserve purchasing power better than holding cash directly. Financial instruments are defined as cash equivalents if they are highly liquid products that have active marketplaces, are without liquidation restrictions, and are easily convertible to cash. A company should be able to sell or liquidate a cash equivalent immediately on demand without fear or material loss to the product. Cash and cash equivalents are the most liquid current assets on a company's balance sheet. The assortment of financial products that comprise the balance of this classification usually have maturities of 3 months or less, are easily convertible to cash, and must not be tied to restrictions that limit their liquidity. Companies often hold cash and cash equivalents to pay short-term debt and hold capital in secure places for future use. Here are 5 key takeaways. 1. Cash and cash equivalents refers to the line item on the balance sheet that reports the value of a company's assets that are cash or can be converted into cash immediately. 2. Cash equivalents include bank accounts and marketable securities such as commercial paper and short-term government bonds. 3. Cash equivalents should have maturities of 3 months or less. 4. Cash equivalents must also be able to be liquidated to cash. For this reason, cash equivalents often have active markets. 5. A company carries cash and cash equivalents to pay its short-term bills but to also preserve capital for long-term capital deployment. Hope this would help. Thanks for watching.